Welcome to another lesson on technical analysis. Previously, we have looked at trend lines and how to effectively draw them. Today, we are going to make use of these trend lines to identify chart patterns. And using these chart patterns, you'll be able to better identify potential top and bottom to benefit both your trading and investment timings. Just like candlestick patterns, chart patterns serves as a signal to potential trend reversal or trend continuation. So naturally, they're also categorized into two types, reversal patterns and continuation patterns. Now, reversal chart pattern signal a change in the trend from a downtrend to an uptrend when the pattern is spotted and completed, and vice versa. As for continuation patterns, these patterns signals that the preceding trend is likely going to continue after the completion of the pattern. And these appear in the middle of the current trend as brief period of rest or consolidation of stock prices. So obviously for these patterns to work, you must first have a trend because the purpose of this pattern is to signal a change or continuation in trend. Next, the larger the pattern, the larger the breakout move upon completion. Now when we say that a pattern is large, we take into account the height and also the width of the pattern. So the height measures the price and volatility. A volatile pattern, you can think of it like it is one with a lot of energy. So once it breaks out, you expect it to burst off with energy as well. Now width measures the time. So the longer the pattern requires to complete, the more significant the pattern becomes. And likewise, the larger the breakout move as well. So think of this like energy being trapped and accumulated for a long time. Once you release it, it is going to fly. Next, some people look at volume. Volume tells you about the amount of market participation out there. If a pattern is widely monitored and the breakout is valid, then a large increase in volume on breakout should be observed, and this could be used as a confirmation that the pattern is valid overall. So all this will be explained in greater details as we move on the individual patterns. And first up, we have the head and shoulders. Head and shoulders reversal pattern goes like this. We have our regular uptrend as seen from the higher highs and higher lows. And then what happened next is that we start to see prices making a lower high. So once we see this, we can connect the most recent two lows to give us our neckline. So from our lesson on trend lines, we know that the neckline is actually a potential support because it connects at least two lows. However, even if we see that the prices come back down to touch the neckline, all we can say right now is that our uptrend may be weakening, or that the uptrend may have shifted into a sideways consolidation. A trend reversal has not occurred yet. Now a reversal is confirmed, or we say that the head and shoulders pattern is completed when this correction breaks our neckline over here. So on a strong reversal and breakout, prices will continue to decline from there. And if the breakout is not as strong, you may observe a return move back to the neckline. This time the neckline should act as a resistance to the small rally over here. And it should reject the prices, and subsequently the price should decline further from there. Now as a trader, we have two opportunities for a trade here. The first one is immediately after the first breakout over here. Now this is more risky as it is prone to false signals. This breakout over here may be a false breakout just to break the neckline for a little bit, and then the prices continue to go back on an uptrend. So the more conservative way is to wait for a rejection at the neckline over here. So a rejection at this point will tell us that the pattern is indeed valid. Now what is the downside of waiting for this return move? The downside is that in the case of strong breakouts, prices will go down immediately and it may never come back up to retest the neckline. For instances like this, traders would have missed their opportunity while waiting for the more conservative setup. Now for both cases, your stop loss should be placed above the neckline as it is acting as a resistance. So you want to place your stop loss above the resistance. Now where should the profit target be? Generally, you can use the distance from the peak of the pattern to the neckline and project this distance down from the point of breakout. So generally, this can be used as a point of reference as to where you should take your profit target. And bear in mind that any strong support or moving averages still take priority and may prevent you from realizing your profit target. So ideally, you do not want to see any strong support or moving average that is in between your profit target distance. Now, how could volume play a part in this pattern? in the head and shoulders pattern, the current uptrend should be losing strength. This is first observed by the trend making a lower high. Next, if the trend is indeed weakening, we should observe the volume at each high or at each peak getting lower as the uptrend continues. And this indicates lower interest from market participants. Now, if the pattern is valid, the breakout should happen with high volume. This shows the strength of the breakout, and then subsequently, should there be a retest on the neckline during the return move, the volume should be light. And generally, you should observe that the volume increases subsequently as the price continues to trend downwards. Okay, so the opposite of head and shoulders is none other than the inverse head and shoulders. And things are just happening this time in reverse. So likewise, we have our usual downtrend, and then we start to see prices making a higher low. So this tells us that the current downtrend is weakening. And with this, we can draw a neckline that connects the most recent two lows. So what we want to see is if the pattern is valid, there should be a breakout over here. And on a weaker breakout, prices will then come back down to test this neckline again before bouncing off to validate the pattern for us. So likewise, for the inverse head and shoulder pattern, there will be two chances for traders to take their trades, once at the immediate breakout over here, and the second time upon the retest of the neckline. So once again, the first opportunity will be a risky one, more prone to false signals. And as for the second one, it is more conservative as it validates that the pattern is valid. However, this retest may not always be present. Likewise, for both trading opportunities, this time stop loss will be placed below the neckline, which is now acting as a support. And then profit target, we can just project from the low of the bottom to the neckline and project this distance from the point of breakout over here. And also remember that any resistances that is within the profit target may prevent you from realizing your full maximum profit target that you have set. So ideally, we do not want any resistances or moving average to be within the profit target zone. So likewise, for volume, you'll see that as the downtrend progresses, at each low, volume should decrease, signifying the weakening downtrend. So the breakout over here should be met with heavy volume, and subsequent return move should be observed with light volume. And as the prices continue to rise, we would like to see that volume increases generally. So what we have discussed and described over here are all ideal cases. Now when you go out to the market and look at the real charts, more often than not, these patterns will not be playing out in such a nice way for you to identify. So you need practice to perfect it. Next, I'm going to show you how we can scan for trading opportunities involving this head and shoulder pattern, as well as the inverse head and shoulder patterns. FinViz is a good website for us to screen for trade setups. So ideally, what you want to do is to go over to the Screener tab and then key in your different criteria to screen for. So generally, when trading, I would like to see that the average volume is above 200,000. As traders, we want liquidity such that our bid-ask spread will not be as wide, and then we get filled at optimal prices. Next, we want the price to be over $5. We want to avoid those penny stocks, which could be manipulated at times. And after that, we could go over to the technical, and under pattern, you can select the pattern that you want to scan for. So over here, there's an entire list of pattern. So what we want to look for is the head and shoulders or the inverse head and shoulders. So just select it, and here comes your list. So if you have to use the FinViz screener very often, what you can do is to use this drop-down list over here and click on Save Screen. And you just save all this setup for you. So we have our list of stocks over here. Next, you can mouse over them and then you can take a look at the rough chart patterns and see if any of those fits into the head and shoulders pattern that we have just discussed. So you can see that not all the patterns are as nice. For example, this doesn't really fit into our head and shoulders pattern considering the recent huge fall that it has experienced. So perhaps one good chart to look at would be PDD or maybe ACAD. So let's go into those. So PDD, the first one. So this is the daily chart for PDD. Now this chart is pretty straightforward and easy to identify. Did you already identify the head and shoulder pattern in this chart? So firstly, we can see that the stock is on an uptrend, making a high over here, and then continue making another high. Now this time, next high that it is going to make, it is now a lower high. So with this, what do? We can use the trend line options and then start to draw a trend line to connect the recent two lows. these two lows over here. And if you were to draw a line, it would be something like this. So you can adjust a bit and look for the most ideal line possible. So now we have the neckline. Next, what we want to do is to observe the chart and wait for prices to break this neckline over here. Now, can you see that there is a 200-day moving average support down below? So this could be acting as the next support. And when the prices does break down, it could bounce off this 200-day moving average. So most likely upon the first breakout, it'll be wise to wait for the prices to break the 200-day moving average as well. Or otherwise, you can wait for a rebound back to test the neckline, and subsequently upon rejection, then you enter your trade. Okay, so this is PDD, and next for ACAD. Now you can see that this time round for ACAD, the pattern is not as clear. So you may say that this could be the head and shoulders pattern. And if that's so, then you may want to draw a trend line connecting the recent two lows. So that will be generally be like that. If this pattern is to be taken like as it is, then you can see that this time when the prices come back down, it sort of break through a little bit and bounce off 150 MA and continued on for another high. There is still a lower high over here. And subsequently, upon this break, again it bounced off. Now, could this be a breakdown and then come back to retest? We have to wait and see. If prices does indeed show a rejection from the neckline down, and if it can break through the 200-day moving average, then it will be safe for us to enter this as a reversal trade. And generally, how you can project the profit target would be to draw from the tip to the neckline, and then after that, just shift this line down. So this is just one very crude method. And you can see that within the profit target, there's indeed some other support and resistances. You can see one very clearly over here, acting as a support a few times and then turn into a resistance subsequently. So this time round, it may come back to act as a support again. And if you were to take this trade, then you'll be wise to take profit target over here. And for stop loss, perhaps we could put it somewhere above all the current moving averages, which will now be acting as a resistance. So somewhere perhaps here, or if you want to be even more conservative, you can place it at the top of the most recent high. So this is one way how you can trade head and shoulder reversal patterns. So as you can see, technical analysis in trading is going to be very important. So if you have not brushed up your skills yet, I urge you to go and practice more on fresh charts every day. Alright, the next pattern that we have may be a little bit confusing, especially for beginners. And this pattern is the double or triple top reversal pattern. It starts off similarly like the H&S pattern. So our usual uptrend, except that this makes equal highs and equal lows instead. So likewise, when this pattern appear on the chart, or we can say that the uptrend has turned into a consolidation. And with this, we can draw a potential resistance over here and a potential support over here that's connecting 2 points. And also we can say that there is a potential double top pattern. Now keyword here is potential. It has not formed yet until prices break down from our potential support right here. Only when the breakdown is observed, then the double top pattern is valid. And likewise, a return move is possible on a weaker breakout. And this return move could test the new resistance, and it should be rejected by this new resistance to show that the pattern is indeed valid. So just like the head and shoulder pattern, two trading opportunities. The first one upon the immediate breakout, the second one upon the rejection by the resistance on the return move. And again, the first one is more risky and the second one would be more conservative, but you may not always have that. And for both trading setups, the profit target will just be the projected range of the consolidation and projected from the point of breakout over here. For both trade setups, you would like to place your stop loss above the new resistance over here. Again, remember to look for nearby supports as these take priority and may prevent you from realizing the maximum profit target. Now this is the double top. For the triple top, prices just bounce within the consolidation range one more time. And every other characteristics of the double top pattern stays the same for the triple top pattern. Overall, take note that the reversal from a general uptrend to now a general downtrend. Now, volume should play out similarly well also. You'd like to see the volume getting lighter across each peaks that we are progressing through, and heavy volume should be experienced on the breakout, and with subsequent increase in the volume as the prices continue to reverse downwards. Should there be a return move, the rejection should be met with light volume. And as for the opposite of the double triple top pattern is, you guessed it, it is just called the double triple bottom. And again, everything is just happening in reverse. This time from a downtrend to now an uptrend. And again, every other characteristics of the double triple top stays, but played out in reverse. So equal high and equal lows with a lighter volume on each low, and upon breakout, there should be increase in volume. And also, should there be a return move, it should be met with light volume. So trading setups is the same. The first time upon the immediate breakout, and the second time on the bouncing off from the new support that is formed over here. And profit target is just the range of a consolidation projected from the point of the breakout. And for both trading cases, we would like to place our stop loss below the new support line over here. Now, the double or triple top or bottom patterns present many opportunities for traders. And now I'll be walking you through my thoughts during each phase of the pattern formation and how I spot for trading opportunities. So as we have previously pointed out, prices will be in a general uptrend for the double top or triple top pattern. And you will hit here, you make a high, come back down to make a low. Now, so far, there is no trading opportunity to be seen. And as prices make another high, this time around, I'll start to draw out my potential resistance over here. Now, in the usual uptrend, I'll expect when the price come back down to make a low, it should be a higher low. But if this correction persists all the way down to the same point as the previous low, now I'll be able to draw my potential support over here. Now, even then, a trading opportunity has not surfaced yet. Should the prices bounce off here, I will not be taking a trade. Why? Because this potential support that I've identified is only tested once, and I would not have enough confidence to trade anything off this potential line that I've just identified. Now, if the price break down from here, personally, I will not take the trading opportunity because personally, I'm a more conservative trader and I would like to wait for a rebounce, a return move to test the new resistance before I take my swing trade right here. Okay, so this presents the first trading opportunity that I would have spotted if I'm analyzing the trade. Now, should this break out be false, it doesn't matter. I'll just let it run. And this time, if it hit the same potential resistance that I have drawn out previously, I'll be monitoring closely. Two things can happen here. First one, it will be rejected and prices should go down. Now, what's the second scenario that is likely to happen? Prices could break out of the potential resistance and continue into its uptrend. So which one would I be looking out for? Now, some traders may be inclined to short the stock over here and ride the wave down, thinking that this is a consolidation. Now, nothing wrong with that, just that personally for me, because the preceding trend is uptrend, and I believe that a trend in effect should stay in effect. So to me, it is more likely that prices should break out than to come back down. And personally, as a trader, I would like to trade along with the trend and not against the trend. So if it indeed does break out, then I'll enter my trade here. I'll place my entry point somewhere around here and my stop loss somewhere around here and ride the wave up should the breakout be a real one. Of course, in these breakout instances, there may also be a return move down and to test the new support before bouncing off again. And this may present the second opportunity for traders to take. Now, let's say if the breakout didn't happen and the prices continue to go down. Now, this time round, it could be a potential triple top pattern. If the prices break down from here, the triple top pattern would be valid. And this time for the triple top pattern, should it break down, personally I would have the confidence now to trade on the first breakout. Why? Because this potential support that we have identified has now been tested for 2 times. So, breaking down from this support, I'll most likely believe that the triple top pattern is real. And in general cases, triple top patterns are easier to identify than double top patterns. So double top patterns most of the time seems to give false signals. and which is why I do not trade the first breakout for the double top pattern. But for the triple top pattern, I tend to be slightly more aggressive. I'll take the trade upon the first breakout. Now, instead of breaking down, there is another scenario, and that is for the prices to continue to stay in consolidation and bounce upwards from here. Now, remember what I said about trading with the trend? Now, this time, if the stock prices can show a bounce from this potential support that I have drawn, I will be inclined to take a swing trade up and ride the wave up to the resistance again. So why? Because the preceding trend is an uptrend, and now the prices is going up. So it gives me the confidence that prices is likely to continue going up than to come down. And therefore, if I were to take a swing trade here, it should be relatively easier for me to hit my profit target at the resistance that we have identified. And for trades like this, stop loss would generally be placed below the horizontal support that we have identified. So this trade that I've just talked about is called a consolidation trade or trading in range. And I'll be going through this particular trading setup in future videos in further details. So generally, in a consolidation like this, how many trading opportunities have I picked up? So the first one, upon the retest of the double top pattern, I will not ride the wave up because my potential trend line has only been tested once. Next, if it continues to bounce off the horizontal support and hits the horizontal resistance, then here comes the second opportunity, which is the breakout from the resistance. This is the second opportunity that I would be taking. And the third trading opportunity will be the breakdown from the horizontal support that we have identified. So this would be a validated triple top pattern. And lastly, the fourth trading opportunity comes if this breakdown makes a return move and then prices continue to be rejected by the new resistance. So this is the fourth opportunity. And lastly, should the price bounce off instead of breaking down, this would be my fifth trading opportunity to ride the wave back up to the upper boundary of the consolidation. So there you have it, guys. How to properly identify reversal chart patterns and how to trade consolidation patterns like this. So I hope you have gained new trading insights and strategies, and may these strategies help to enhance your trading portfolio and journey along the way. So this is Growing Wealth. Remember to like, share, and subscribe, and thank you so much for watching. See you next time.